Good afternoon and welcome to the market update for April 30th, 2020. My name is Jeremy Fair and I'm the founder and CEO of SIA Wealth Management Inc. and SIACharts.com. The big news in this update is the change to a green equity action call, which means we will now have better risk reward for equities in all of our portfolios. Let's get to the charts to see how the current setup is. First chart I want to show is our equity action call, our highest level of analysis. As we can see on the far right, we've moved to the green in the mid part of the green zone on the equity action call. This was a fast move up from grossly oversold levels. And as many of you who have been following our webinars over the last 6 to 8 weeks have known, we've seen some dramatic changes in short periods of time. Today is no different with a fast move back to the green. I've highlighted to the left of that current update the 3 other times where we've moved to the green zone from the red zone since the inception of the equity action call back in 2005. We had of course, the big bear market of 2008 going into 2009, where we saw in the early part of 2009 back to the green zone, followed by a bull market or a bull run right to the mid part of 2010. So we got more than a year of bullish activity during that time frame. Fast forward to 2011 and the early part of 2012. We moved back into the green zone. We saw a brief move to yellow, but had our longest stretch in the green zone from that point forward, right from the latter part of 2012, right up until 2015, where we moved back into the yellow. In 2016, we hit the red. Again, some strong intervention from central banks and governments. We were pulled back out of that one into the green and had an extended run right up until the latter part of 2018, followed by a shorter term move in 2019 where we saw less than 12 months. So we get a lot of questions on time and duration in the green zone. What we can see from history here is that we get anywhere from nearly a year or longer while we're in the green zone. So it does and is designed to be an intermediate term indicator representing intermediate to longer term trends within the equity space. Our second level of analysis is our asset class rankings. There were significant changes as of yesterday, the most important being international equity moving from the 3rd position right up into the 1st position. This is an extremely positive move. International equity has remained the strongest of the equity asset classes for the duration of this downturn. Cash moved down into the 2nd position, followed by currency moving down into the 4th, with U.S. equity also moving up a couple of places from the 5th position to the 3rd position, and Canadian equity moved up 1 spot as commodities got pushed from the 4th position down to the 6th. So overall, a very, very bullish move. This comes on the back of, as many of you know, a long, about a month rally within equity indexes, those cap-weighted indexes. But what we've noticed over the past week is that some of the smaller names have started to participate, and that's why on our equal weight basis that you see these changes with international equity, U.S. equity, and even Canadian equity down at the bottom there, seeing positive moves over that time frame. So one of the most asked questions we're seeing is, why did we go back to the green zone with so much bad news? Well, there's a number of reasons for that. As it turns out, the ongoing threat of COVID-19 is helping markets. With the COVID-19 shutdown, the subsequent central bank intervention, purchases of fixed income products, junk bonds, et cetera, they've really got a blank check. So we've heard the Fed talk about a blank check. Governments also have a blank check. There's very, very little happening from opposition parties around the world standing in the way of any source of fiscal or monetary policy that is going to perceive to help the COVID crisis. So as long as we're in the COVID crisis, it appears as central banks and governments will have blank checks. That has created tremendous liquidity in the market and added to the opportunities for people to purchase equities. The second is there's low quality and junk bonds have been purchased up by central banks. So this is a significant change. This is a recent phenomenon in this crisis over others, where central banks have gone down to some of the lowest quality corporate debt that are out there. And this has given risk takers an opportunity to get their money back, because many of you may or may not know, but most of those bonds went very, very low bid, suggesting that there was going to be a huge default rate. So for those who were holding low quality and junk bonds, you had an opportunity to not only move off of your bond positions, which had been showing for a short period of time some very, very negative returns, but you got your money back. And now you have the opportunity to deploy that into equity. So this is ongoing. The purchase of these fixed income products, these low quality fixed income products, continues as we do this. The third area is that bond markets have really struggled with the federal, state, provincial governments borrowing trillions of dollars around the world. The issuance of new fixed income securities is going to be happening at an unprecedented scale. This is spooked bond investors. Bond investors, institutional size, have been moving off of their bonds. We see this in money flows through the ETF universe, and seeing inflows going into equity. So these three situations have really created an opportunity, even though the fundamentals may not suggest it, the valuations may not suggest it. There is really just a lot of cash chasing very few goods, and equities are the only game in town with liquidity that offers some sort of upside with them. So just a brief comment on this. What could derail this? Certainly COVID-19 having some sort of conclusion to it. We just outrun the COVID-19, or there's some sort of cure, vaccine that comes out, or some medicine that can dramatically reduce the risk in it. Then I think we would see some governments starting to get looked at by the opposition parties for how they've handled this. But until then, I would suggest that there's a low chance that opposition parties are going to stand too much in the way of these blank checks. The low quality and junk bond purchases are expected to continue. So if there's any cancellation or change in central bank policy towards this, which is happening at some of the largest central banks around the world, that would certainly create a problem. And if for whatever reason the amounts of debt that are going to be issued by governments is less than expected, which that would be a first in my books, then potentially some of that supply that has been coming out of bonds would reduce exposure to equity purchases. The first chart I want to look at today is the SIA Charts Market Equal Weight Index. This is a chart that I brought up many times. Being an equal weight index, it has lagged the cap weight indexes for some time. Only over the last week or so has it started to move up, as in conjunction with some of those cap weighted indexes, which is why we see the green zone happening today. So looking at the chart, we've got our first level of resistance about 5% above where we are. That would put us somewhere into the early March downturn of this, and you can see there's a couple of resistance points back in 2019 in July as well as in October that touched off of that level that now serves as resistance for us. The second level of resistance is 14% above it. So even on an equal weight basis, there is on a risk reward level opportunity to see some more advancement from here. Certainly after the run-up we've had, that would be a concern for many people. Support is nearby, 3-box reversal, so 6-7%. We are certainly slightly overbought, and a pullback in the markets is not to be unexpected after a long run-up here. So a pullback would be a situation where we may consider adding to positions. I highlighted this chart yesterday in our weekly update, International Equity versus Bonds. I just wanted to present it again today to show that we have broke above resistance. So even in comparison charts, you can use technicals. We see that the prior resistance level has now been breached. We're in an uptrend line. I certainly like to see that. Those uptrends tend to last for periods of time. So we are looking for 6 months or longer when we hit the green zone, with the green zone call we have here, with the historical equity action call greens showing us even longer than that. So a 6 to 18 month time frame is not unrealistic looking at. So we've got a positive SMAX score, certainly a great turnaround for international equity, which sits in the first spot. The second one is U.S. equity versus bonds, so very, very similar. It was sitting right at its downtrend line as of yesterday. That's why I wanted to highlight this chart as well today, or the three that I follow up from yesterday that I highlighted in that webinar. We see we moved up here, positive SMAX. So again, this is good to see equities, and again, shows us that money flow that is coming from fixed income is moving into equities. The third chart on the comparison side is Canadian equities versus bonds. Certainly had a more significant downturn than both international and U.S. equity. There's more work needed here. It has moved up. We can see where the prior level was as of yesterday. So a strong move up in equities versus fixed income, but again, has some work to do above it to get into that uptrend situation that we would like to see. But again, Canada is ranked, still remains relatively low in the 5th position in our asset class rankings. So we would expect a little bit less out of Canada as we move forward. The next three charts, I just wanted to highlight some areas of strength within the international, US, and Canadian space. So in each of these, there's different areas. New Zealand is an area that I wanted to highlight. New Zealand had ranked very, very strong going into this crisis starting in later February. And coming out of this has returned to its relative strength. So positive SMAX, it just broke through key resistance at that 49.36 level. Has room to move right up to the highs of February here on a risk reward basis. Looking as we now have equity action call green, positive trend on this chart. We would look at a second resistance level as a potential price objective. So that's about a 15% move above where we're sitting today. So a reasonable risk reward with support sitting above that 46.52 level. On the US side, I wanted to highlight the US ETF large cap growth, so EWI. So this is an equal weight index where we're measuring many of the large growth ETFs within the United States marketplace. It, just as New Zealand did in our international, one of our international views, broke through key resistance. So that happened here just recently. It's got room, again, not dissimilar to what we see with some of the charts like New Zealand to test the highs of February, but actually go beyond that. So a very, very bullish chart. A price objective, again, looking at our second resistance level, is 18% above. And again, just like many of the charts we're looking at here, support does sit nearby. A 3-box reversal to the downside is what we're looking at. So positive there. Again, just highlighting both international and US and in Canada. One example of the areas where there appears to be opportunity. And the third chart I want to look at for the Canadian space is the Canadian Precious Metals Equal Weight Index. I want to highlight this chart because, again, not dissimilar to the previous charts, it broke through key resistance recently. The price objective would be as approximately 14% above where it sits today. So the risk reward is quite reasonable, given a 3-box reversal would show us the support. One of the things to mention about Canada, and I think aligns very well with its relative underperformance to the other two international and US equities, is that Canada remains very, very sector specific as far as its opportunities. So when you're looking at the Canadian marketplace, be sure to look at the relative strength of those sectors and go from there. With that, just a quick update today. Certainly, it's been a very, very trying time, but we do see positive. We do see positive risk reward now with an equity action call of green. So please leverage myself and the SIA Wealth Management team going forward on this, and we will be doing a webinar as late as Wednesday. We will have a scheduled webinar. I'll be able to get into more details about individual holdings and other opportunities for purchase out there. But please remember to take a look at the SIA Wealth Management portfolios through Bank of Montreal. We've got a long relationship with them, so please take a look at those. If you have any questions, please reach out to myself or any members of my team. With that, have a good week, and we'll talk to you soon.